Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So what I'm going to share with you guys today is 6 different companies that are high growth businesses. Some are undervalued, some are just fairly valued. The stock market is starting to give us really good opportunities, and I mean genuinely really good opportunities. If you have been waiting on the sideline and you have not actually purchased any stocks because you were worried about stock market and so on, now is the time to get your cash ready, because I genuinely think there will be some great opportunities and they're starting to happen. Now I'll give you a great example. Adobe just reported earnings, and as you can see here, they're down about basically pre-market about 7-8%. So by the time the market opens and the night closes, it'll probably be about 10% down. Now you would be thinking something horrific must have happened to this company for this company to be down right now over 7%. Okay, let me show you. Okay, let me show you here. Now top line, bottom line, both of them are green, both of them are beat. Nothing to worry about here. I'll give you exactly the reason why this stock is down as much as it's down. There was nothing in the earnings report to suggest this company is going downhill, whatever. The only bit that's different is this line here. Okay, the total revenue, so this is what they expect. Total revenue of $5.5 billion to $5.55 billion. So that is what the company has said. This is what Wall Street was expecting, 5.6. Look at the difference, 5.55 or $5.6 billion. That's the only line, that's the only reason the stock was down that much. So I really like this type of basically earnings report. When something like this happens, it's a great opportunity for long-term investors. If you're day trading, of course, then that's a different ball game. Check this out. Okay, when we look at the revenues broken down into two, so Creative Cloud and then Document Cloud, basically $3.1 billion. That quarter over quarter, that was about 2% up from this time last quarter. So they have actually grown that side of the business about 2% since last quarter, last 3-4 months. Now the year over year was 9.6%. Check this one out, 3.2% quarter over quarter, 17.8% year over year. Is that a problem? Is there any problem between like these two sides? No, everything is up, heading the right direction. And look, check this out. They basically Document Cloud and both of them, the revenue side of it, both of them are growing every single year, a quarter. Okay, from 2.6 to right now 3.1. Every quarter we grew this, which is absolutely amazing to see. So then you've got the digital media side of things. So 3.9, so 2% quarter over quarter, year over year by 11%. The digital experience 2% up, quarter over quarter 10% up. So absolutely nothing to it. And then that side of things as well, it's heading the right direction. So when you see something like this, it's just annoying to see investors basically selling out of stock because Wall Street starting selling out. So if you're a long-term investor, you wouldn't have absolutely nothing to worry about. Right now, you'll probably be buying this company. If it was in your portfolio, you'll probably be adding to it. Okay, and I'm not saying go away and buy it. You could do a little bit more research on your own and so on. But what I wouldn't do today is I want to share with you 6 different companies that are high growth companies. These are very high. They've got excellent margins, and right now they seem undervalued or about to become undervalued. They're fairly valued right now. Okay, but before we do that, I would really appreciate if you can join us at the Patreon account, where you get access to a lot of things, including Discord, where a lot of brothers are sharing very good practices day after day. And of course, you get access to all my buys and sells when it comes to either the family portfolio or the individual portfolio. You can also download the entire portfolio in a PDF format for both family and the individual portfolio, inshallah. Right, join us on that side. Let's now get started with the video. And the first company we're going to look at today is Fortinet. This is one of the cybersecurity companies, and the things that we're looking for is the usual things, but one of the most important things for growth companies is to look at price to earnings to growth and ratio, which was made famous by Peter Lynch. So what we want to see is this number, okay, below 1, and if it's below 1, that's normally a very cheap stock. If it's between 1 and 2 is reasonable. Anything about 2, it's kind of way too expensive. And the growth side of it, keep an eye on that, because that's where we want to see the growth of these companies next few years, inshallah. As you can see, it has a 57 billion market cap right now. It has wide economic moat, $74 per share right now. EPS is just above $1, and PE right now 44. The forward PE is about 36, and PEG ratio 1.56. Now the last 5 years, when it comes to revenue and when it comes to EPS, 23% and 42%, which is absolutely amazing. Profit margin 23%, return on equity of 430%, and return on invested capital of basically 100%. Now majority of the big companies that we're going to talk about is what I like to call growth at a reasonable price. So these companies have been around for quite some time. They have a positive earnings, so they're not really high risk businesses. So I just need you to know that. Okay, now let me quickly show you what Seeking Alpha is saying about this company. As you can see, Wall Street is saying it's a buy right now. 8 buys. We got 8 buys and 8 strong buys, 27 holds right now, and we got basically downside about 2% from where we are right now. Earnings expectations moving forward for this company, 25% this year, 2024, 2025 we're looking about 9%, and then 15% after that, 14%, and so on. So when it comes to revenue side of it, we're looking double digits every single year for the next few years. So absolutely nothing to worry about when it comes to the overall business. The next company we're looking at is AMD, another company that I don't own it right now, but I did own it for quite some time ago. I think about 3 years ago. I think I did own it when it was, the stock was I think about $30 to $40 per share. Then it went all the way to 100, I think, at the time, and I sold it. It was 2021, I think, when I sold it. But as you can see, it's got market cap of 244 billion. Market cap is quite huge, but it has a narrow economic moat because I don't think they have a moat around their products right now. When it comes to EPS, it's a positive. Current PE, we're looking at about 181, which is absolutely ridiculous. Current PE we're looking at 44, but price to earnings ratio, or growth to growth ratio, which is the PEG ratio here, we're looking at less than 1. So that says it is basically cheap right now. The 5-year growth rate when it comes to revenue and when it comes to an EPS, both absolutely amazing, 31 and 38%. Profit margin 5%, return on equity 2%, return on invested capital is just 1%. Now they're still profitable. They are profitable business, but they haven't got hit that sweet spot yet. $1.3 billion of free cash flow right now. The free cash flow, the compound annual growth rate for the last 5 years. Look at these two companies, right? We're looking at 1.5 and 1.3 and 18% and 57% when it comes to that cash conversion, which is absolutely amazing. Free cash flow, the compound annual growth rate for the last 5 years is 57% for AMD. Total return the last 10 years, we're looking at about 44%. Growth estimate next year, 59%. 33%, and look at this one as well, 10%, 15%, which is absolutely amazing. And both of them are right now undervalued, well, fairly valued right now, where basically they are where they're meant to be, 145, 77, and 74, and 150. Looking at AMD on Seeking Alpha, we can see 32 strong buys, 7 buys, 10 holds, and right now it's about 23%, 24% upside from where we are, 186%. Now looking at the earnings expectations moving forward, 27, 57, 37. Amazing basically when it comes to that EPS. Again, remember, this is just estimates. Anything can happen, things can easily change. If you just focus the first 3, it looks absolutely amazing. And when it comes to same thing for revenue, year over year growth, 12%, 13%, 28%, almost 20%, which is also absolutely amazing. Next one is a company that I own in my portfolio. Broadcom currently has 769 billion market cap, wide economic moat, $164 per share. Is positive, of course. It's been very profitable business for quite some time. Current PE we're looking at about 133. Forward PE 33 only. Price to PEG ratio of 1.17, and last 5 years revenue and basic EPS is doing absolutely amazing. Profitable business, like I said, nothing to worry about when it comes to anything with regards to the management and how they actually managing the business side of things and how they reinvest in the capital that they've got from us. And the free cash flow right now is $18.6 billion. Free cash flow compound annual growth rate for the last 5 years, we're looking at about 17%, 35% total return in the last 10 years, which is absolutely amazing. It's not as good as AMD, but 35% total return in the last 10 years is absolutely wonderful to have. And the fact the company is growing 28% and then 20% every year for the next 5 years is wonderful to know. Now remember, these companies are very cyclical businesses. They do have a lot of the, like basically the networking devices this company owns can be very cyclical, and this one is also the same. It can be cyclical businesses. Okay, so that means sometimes they might do really well in basically when the economy is doing and everyone is buying new products and the AIs and everything else. But soon we might hit a bit of a recession, and people, companies might start cutting costs and things might slow down. So that can change at any time. However, the projection right now, it looks absolutely amazing. $155 per share is where they think the price should be. Right now is $164 per share. Now checking in on Seek Alpha, as you can see, it's a strong buy from Wall Street. 28 strong buys, 8 buys, 5 holds, and 16% upside from where we are. 190 is the price day after. Now expectations for earnings side of things, we're looking about 15%, 27%, 17%, and then 44% when it comes to revenue, 17%, 12%, which is absolutely huge and absolutely nothing to worry about. The next company we're looking at today is Salesforce, another one that I own in my portfolio. 442 billion market cap, wide economic moat right now in terms of PE, 44, 40 PE, 25, and PEG ratio of below 1, below 2. And when it comes to the last 5 years, when it comes to revenue and EPS, is done absolutely amazing. Profit margin is good, return on equity is really good, and return on invested capital as well. $11 billion of free cash flow right now, 29% when it comes to that free cash flow compound annual growth rate, and 16% when it comes to total return the last 10 years. And you get basically in terms of expectations moving forward, and you can see a 10% growth estimate next year, then 16% every year for the following 5 years. Fairly value right now $290 per share is where they think the price should be. Right now it's $253. Looking at CRM on Seek Alpha, as you can see, it's a buy, 24 strong buys, 13 buys, 13 holds, 1 sell, and it's about 22% up from where we are. $307 per share is where they think the price should be. Earnings expectations moving forward, you can see 22%, 10%, 15%, 8%, and so on. 8% and 9%. Okay, 9% for every single year for the following years. Again, another one that's doing really well and nothing to worry about. And if it goes down another 5-4%, whatever, it will become definitely undervalued, and potentially it might be a good one to add to your portfolios. Again, next one is ServiceNow, which is very similar to Salesforce. 182 billion market cap, so slightly smaller than Salesforce. Wide economic mode, $886 per share. EPS right now $5.53, and current PE we're looking at 160, but forward about 64, and PEG ratio above 2. So this one seems a little bit expensive in my opinion. The next 5 years we expect, basically the last 5 years we've got about 27% and 87% when it comes to EPS and revenue. Remember, that's compounded annual growth rate. Profit, we're looking at about 11%, 14% when it comes to return on equity, 10% when it comes to return on invested capital, and $3 billion of free cash flow right now. Free cash flow conversion in the last 5 years about 32%. So free cash flow compound annual growth rate for the last 5 years, we're looking at about 32%, which absolutely is amazing. 31% when it comes to total return, 20% when it comes to growth estimate next year, 22 after that. Fairly value right now $840 per share is where they think the price should be. And looking again, Seek Alpha, as you can see here, is another strong buy here. 26 strong buys, 11 buys, 2 holds, 1 strong sell, and just a flat right now. Nothing to worry about, but they are saying this is still a strong buy. Now, in earnings estimation for the next few years, we're looking about 28%, 20%, 22%, and so on. And when we look at the revenue side of things, 22%, 21%, year-over-year growth of 21% as well. So nothing to worry about. Absolutely, things are going the right direction for this company. It seems right now it's fairly valued, but potentially, if the markets continue what it has been doing over the last couple of weeks, potentially we might get a great opportunity to basically get this one under maybe under basically $700 per share. And the final company I want to talk about today is ASML, the only one in this list that's already 19% discounted right now according to Seek and Morningstar valuation. 315 billion market cap, wide economic mode, current PE 42, but forward PE about 38. PEG ratio just below 1.5. 18% when it comes to the 5-year growth rate for the revenue, 33% when it comes to EPS, profit margin 26%, return on equity 53%, and return on investor capital of 40%. Look at how amazing that looks. Now, $3.3 billion of free cash flow right now, and the free cash flow compounded annual growth rate for the last 5 years, we're looking about 21%. Total return 24%. 56 when it comes to in terms of growth estimate for the next year, 56%, which is absolutely huge. 22% every single year for the next 5 years. Like I've already said, it is basically seems discounted right now. $990 per share is where it should be. Right now is only $800 per share. And finally, we're going to look at Seeking Alpha and see what they say. 23 strong buys, 7 buys, 7 holds, and 1 strong sell. And then when we check out the 40% upside from where we are, $1,129 per share is where they think the price should be. Earnings expectations for this company, well, right now it's flat this year, then 57, 58%, 16%, 23%, and then 2% this year in terms of revenue growth, and then 31%. 10%, 17%, 12%. So anything can happen, anything can change, but these companies seem really, they are high quality businesses. I promise you, these companies are really, really good, but you need to do your own research as well. I like the fact that the growth is there right now. They're all coming back down to discounted values, but right now all of them are fairly valued, which means basically if you bought this price, okay, then you wouldn't have absolutely nothing to worry about. However, I will always add margin of safety. You'd really need that. The fact that this one is down for almost 20%, that's okay. Even if you add 10%, you're still basically within that time, within your margin of safety of 10%, 15%, and so on. Whereas these ones, if you buy it right now, it's a little bit risky. So I probably would wait and see if they hit these prices, and maybe then add another 5 to 10% from there, and depending on your risk tolerance, of course. Right, final thing I want to show you is the Sharia compliance side of things from Zoya. These are basically where the information that you need, so you can pause the video and have a look at that. Now again, like I've always said to you guys, is investing in the stock market is great if you know what you're doing, and don't rely on my just information. Always do your own research. But for me, these companies are high quality businesses. I do own quite a lot of these companies in my different portfolios. AMD and basically ServiceNow are the only 2 companies that I do not own right now in my portfolios. The rest of them, if you're part of the community, then you will know that I do own the rest of them. If you want to join us at the Patreon account, so you got full access to the family portfolio and my actual buys and sells and weekly and dividends and all of this stuff that we talk about, then please join us. It will only cost you 15p per day, and it really genuinely helps the channel. Anyway, I'm gonna stop the video, but before I do, I'm gonna show you ASML, which is in the public portfolio. I'm gonna show you Broadcom, which is right now I'm up 244%, and the final one is CRM, and that will be this one here. There we go. I'm up basically about 6%, own about 10.5 shares. And again, like I said in one of the recent videos, I'm still buying more of this company, inshallah, as we move forward. Anyway, I'm going to stop the video here. Have a wonderful weekend. Have a wonderful day, inshallah. Assalamu Alaikum.